All right, guys, how's everyone doing? This is Paul Singh, market speculator with bullsonwallstreet.com. Really quick, if you can hear me and see me fine, could you just shoot me a message in the chat and we'll get started in a few minutes here. So today we're going to talk about the Swing Trading Mastery Challenge. Hold on one second, guys. All right, so we're going to start here, running into a little bit of a technical difficulty. 1 second here, guys. All right. Okay. So, okay, good. You guys can see me and hear me fine. So today we're going to talk about the Swing Trading Mastery Challenge. We're on day 9 now. So we've done 8 of them. My plan is to get 1 out a day. I fell back a little bit. I got a little under the weather, but I'll get caught up here. We're on day 8 today. Tonight, day 9 will come out. Hopefully you guys have been watching it. Shoot me a message and let me know if you guys have been following the last 8 or so and if you're understanding everything. So what we're going to do today is we're going to go over kind of a case study of the first 8 days so far. So all of the concepts that we've talked about and in the challenge, we're going to do a case study with different stocks and the market to kind of put it into practice. And that's the whole point of this. You know, a lot of stuff that you see online, the articles you read and you forget about it. That's not what we want here. What we want you doing is to actually put this stuff into practice and learn. So this isn't passive reading. This isn't passive learning. This is supposed to be active. That's why with each one of these, there's an exercise at the end of it. So the way these things have been laid out, and let me go ahead and share my screen real quick. And you'll see here, you should be seeing the article and some charts here. Let me know if you can see that okay. But the way these things have been laid out are, I go over a topic that's important. So over these 30 days, I'm going to try to teach you as much as I can to master swing trading. It's going to cover a lot, not everything that relates to swing trading, but a lot. And each one of these concepts you should master. And the way we're doing it is I do a little write-up, basically only what you need to know. And that's the other thing. Sometimes you take a concept like we talked about stochastics yesterday. You take a concept like stochastics and you can get pages on it where they go over everything you could possibly know about stochastics, how it's calculated, the mathematical formulas. You don't need any of that to be a good trader. So I cut all that fluff out and basically get to how I use stochastics and exactly what you need to know so you're not filling your head up with a bunch of other stuff. So we talk about it. Then I'll do a video here where it's really important that you guys watch the videos. So then I'll do a video pretty much putting it into practice. So talking a little about what we wrote here, but you can just read this stuff. Now we want to put it into practice, and that's what this is. Now we get into the more active part where you actually watch me putting it into practice, talking about it, talking about the concepts, and then we get into the exercise. The exercise is after you've read this, you actually put it into practice. And that's what we're doing today is the case study. So I'm not going to rehash everything in these articles. You guys can read them. You can watch the videos. We're actually going to do it now, active learning. So that's the point of today is to get this active learning. We're going to do another one of these webinars at the end of the month. And then another treat for you guys is at the end of this, we have a drawing a random drawing where one person is going to get a free yearly subscription to the Swing Trade Report. That's the swing trading service I run in Bulls on Wall Street, where basically you get a report video every day. You get trade alerts. If I make a trade, you get the trade alert. And you get focus lists and all this other good stuff. You'll get a free year of that, plus 1 mentoring session. So when you're a member of the report, we do now 2 bi-weekly mentoring sessions, like a group session, where we get together, I teach a concept, you guys ask me, report members ask me questions. We do those twice a month. We're also now, if you win this, you get a free personal mentoring session where I'll go over whatever you want to go over. So we're going to do that drawing at the end of this YouTube live here. So stick around for that. One person is going to win. And then at the end of the month, we're going to do another one of these where, we're on day 8 now. By the end of the month, we'll be on day 25 to 30. And we'll do another case study, putting a lot more stuff into practice. And then we'll do another one of these giveaways as well. So what I want from you guys now in the chat, we're doing a case study, and we've been using Netflix in the case in the studies for the 30-day challenge. We'll pick a few different stocks since we've already been using Netflix. I've got an idea, obviously, of the stocks I want to use, but I want to get some feedback from you. What stocks would you like for me to add to the case study? So I'll do 2 or 3, maybe four different case studies, depending on how much time we have. I try to keep these between 50 minutes and an hour, because if they go too long, we tend to lose our focus. So I'm going to try to get through all of this really quick. Maybe 2, 3, 4 different stocks that we'll do the case studies with. Walmart, that's kind of a slow-moving stock, although retail has been moving. I'm probably not going to Sushmi. I'm probably not going to use Walmart. Shutterfly is a good one. We could potentially use Shutterfly. So why don't we think about adding Shutterfly? I'm going to write that one down right now. And you see, we're going to do this in real time. So it's not like a stock that I do. Actually, Shutterfly is on my focus list, but it's not anything I have prepared. We're going to do this together. So we're going to be thinking on our feet, putting this into practice on our feet. We've got CMGO, some stocks that have not been on my radar. CMGO didn't come up. Maybe you mean CMG, Chipotle, which is a decent stock. I'll think about adding Chipotle. We've got Netflix. I'm already doing Netflix in the challenges, so we'll skip Netflix for now. Facebook, I'm actually in a current trade. Let's go ahead and use Facebook. So we've got Chipotle, Shutterfly, Facebook. I know I'm skipping some of you guys. If it's a stock that I don't want to use, I'm just going to go ahead and skip it. I'm getting a ton. But Snapchat is an IPO that's been on fire of late. We could think about that. Roku, I'm in right now, so we could potentially use that one. It's been a really strong stock. Lulu, another good one. Okay, we've got some good suggestions here. I think we'll go with HUYA. I'm getting a ton of good suggestions here. That's another IPO. We'll go through as many of these as we can. I think we've got a good list here. Okay, so I'm gonna get off the screen here and share my desktop. So you guys should be seeing my desktop now. And we're going to go through this. So we're going to start. We pick the stocks now. The last 30-day challenge was overbought and oversold conditions using the stochastic indicator. So basically how I use the stochastic indicator. And let me pull up SPY here. All right. Twitter, boy, you guys are still throwing up a lot of good suggestions. I don't know how I'm going to narrow this down, but we'll go through a few of these. So let's start with, these are all the different lessons here we've done so far, or challenges we've done so far. Let's start with market analysis. Now, this is something that a lot of traders skip. They don't do a really deep analysis of the market, and it's really important that you do this for a number of reasons, not just specific to the trade itself. But the reason we're doing a market analysis is it's going to help you define your trend, define how you should be trading. And when I say how you should be trading, there's a lot of different aspects to that. But the main things we're going to talk about right now are how aggressive you should be being, how you should be. So for example, let's say I'm just going to use 100,000 because that's what we use in the trade report. But it could be anything, whether you have a $5,000 account, whether you have a $20,000 account, whether you have a $1 million account, whatever it is. You're not always trading all of it. And there are going to be periods where, let's say you have 100,000, the market is not great. You're only going to trade 10 or 20 of it, or maybe none of it. There are going to be other periods where it's a really good market. Maybe you want to trade 80 of it. Then there are going to be some really strong markets where you want to get as much leverage as you can. And maybe you even go on margin and trade 200,000 of it. And that's fine if you understand how to manage risk. And we're going to talk a lot about managing risk. So how do you decide when to be doing this? And this is what really separates a lot of the good swing traders. A lot of bad swing traders who, when I say bad, I mean they're not profitable, even though they know a lot and they understand the setups. They're just taking setup after setup. And that's not what you should be doing. So, I could pick any day of the year, even in the worst market, and I could find setups triggering, but that doesn't mean I'm going to take them. I need to know when I should be taking them, how much I should be taking. So your market analysis is going to help you decide that. Now, it's also going to help you in terms of the setups you should be trading. So think about that. We trade a basket of 30 or 40 different setups, maybe even more. But I'm not always trading those setups. Over the last year, I've really been focused on 4 or 5 different setups: earnings breakouts and setups related to earnings breakout, continuation patterns, and then setups related to stocks that are extended and then shorting those. And that's basically it. That's all you've needed to do. Now, in this past year, and I've got the yearly chart here, if you've been trading like continuation downtrending short setups, you've probably been getting crushed, because look at what the market's doing. Almost all the stocks are going to be going up, and you're fighting that trend. So you need to know what market you're in and then apply the setups that you're going to be trading. That's why this market analysis is really important. So I say to myself now, we're in a strong market. The market is uptrending. I should be trading continuation patterns. So the 6 or 7 continuation pattern related setups that I trade are what I'm going to be focused on. And that comes from starting with my market analysis. So you can see how important the market analysis is. Another way it helps us is it helps define my targets. And I'll pull up Netflix as an example of that. We talked about it actually in this video here. If you haven't already, check out the video. But I entered Netflix here. It was a continuation pattern when it remounted the 9 EMA. Let me get a little closer here. When it remounted the 9 EMA right in here somewhere around 314. That's where I entered. I had about a 7 to 10 point stop, and then my initial target was at the top of the range here at around 335 to 340. That was going to give me a nice 2-to-1, 3-to-1 type win, and we'll talk more about risk and all that if you don't understand what I'm talking about later. And remember, if you don't go through all these lessons, because you'll be a pro once you go through them. Now, normally I could just get out there and I'd have a nice win. 2-to-1, 3-to-1, that's exactly what I want to be doing. But my market analysis told me that there's a good chance we could break this resistance level, because the market could help carry the stock. And when you think about the stock you're trading, it's not just all about that stock. You could have a fantastic stock. If the market is poor, it's not going to move. Same with its sector. So the market and the sector makes up at least 50% of the stock's move. And we decided, according to the market and the sector, that there was a very good chance that it could break the resistance levels and we could go for a bigger win. So we trailed our stop and actually got out at about 355. Now, it did go even further, but still, I got basically another 20 points from where my initial target level was. And that wasn't because of the stock itself. We focus a lot on the stock we're trading and stock picking. It was because of the market. It was solely because of the market that I went for the bigger win, and that gave me basically 50% more than what I was going to make on that. So again, you can see how important the market analysis is. So when we're studying market analysis, we're going to look at a few things here. These 1 through 5 points right here. What is the long-term trend of the market? And looking at SPY, and when I say the market, I mean SPY, QQQ, which is a NASDAQ related more to tech, and then IWM, which is a broader index than SPY is. 2,000 stocks instead of 500, and not as weighted in the big guys. So it gives you a better, IWM and Q, they're going to give you a better indication of what the types of stocks we trade, how they are doing. So let's go back to, let's get back to our SPY starting point. Long-term trend is an uptrend. Then what is the intermediate and near-term trends? Intermediate is basically, even though we're in a long-term trend, we're basically range-bound in the intermediate trend. So that's significant to us. That helps us decide how we're trading. Now, since we're in a range bound market, we're going to focus, say, less on breakouts and more on range type setups where we only go to resistance levels. That's changed a little bit when we add in our near term, but basically through this period in here, basically February to April, we traded very conservatively because that's what the market was telling us here. Through this period, it was very rare for me to be in over 1 or 2 positions on that account that I trade through the report. I trade a lot of other accounts, but specific to that account, 1 or 2 trades. Now, more recently, we've been in 4 to 5 positions because we like what the market's doing. I'm in 5 positions right now. Facebook, ERX, which is an energy ETF, X, Roku, and Baidu. The main ones, Roku, Baidu, and Facebook, that I think we can really move right now. So we're being more aggressive because the intermediate near-term trend is very strong. What I mean by very strong, it goes to point number 4. Are there any hidden underlying factors? Now, when we look at the chart, all we can see is price action, which is very important. But there's other things we need to be looking at. You know, you're going to look at what I call market breadth indicators, and we don't have time to really get into in depth on what those market breadth indicators are. But the quick way for you guys to do it is, if you notice something as simple, if you start to notice more stocks that are showing up on your watch list, the stocks within your watch list, they seem to look stronger, and you're just finding more stocks to trade. If you notice all of these indexes are all showing a lot of strength, these types of things are going to tell you that you're in a strong market. We were not seeing that in here. We are seeing that now. So, and then which market index is leading the market? We want to see Qs and IWM leading. That means it's a very strong market, and that they are leading right now. If we look at SPY, SPY is way down here, hasn't even hit its high yet, whereas the Qs are at all-time highs and IWM is at all-time highs. That is a very good thing for the market. So because of that, we have decided to get very aggressive right now. So whereas our market analysis was telling us take it easy during these 2-3 months, I know it can be frustrating not to make a lot of trades, but our market analysis was telling we need to slow down. I don't care if I even see 5 setups in a day, I'm not going to take them all because I know the probability for those setups is not that great. Whereas basically late April to early May, we've been very aggressive, and it's been a really profitable period for us because the market has been good, and we knew to kind of step on the gas now because this is a good period to be trading. So that sets up our market analysis. So this is the starting point for us. So now we've got the market analysis in play. You should be doing this every week. It kind of sets up your week, how you want to be trading. So now we've done the market analysis. Now let's get to macro risk. So there were 4 different lessons on risk. There's setting stops, taking profits, putting that together with your reward to risk ratio. These are very stock specific things once you're in the trade. So we could think of these as micro, but we also have to think of our risk on a macro level. So why is risk so important to us? Basically, we want to protect our account. We don't want to blow it up. And you know, in trading, we need to start with defense first, not offense. So we need you know, our account is our lifeblood. Without a good strong account, we can't trade. We need that account, so we have to protect it. So you can think of the risk within your trade. So let's say the $100,000 account. Let's say we risk 1% a trade, and we'll get into that more deeply when we get into the trades. But 1% per trade, meaning we can trade. We can risk $1,000, and remember, that's not position size. That's how much we're risking. Meaning, if we get out of the trade, how much would we lose? And we're willing to lose $1,000 on a $100,000 account. Now, if you have a $10,000 account, you should not lose more than $100 per trade. $100 per trade. If you have a $5,000 account, it shouldn't be more than $50 per trade. You need to protect that trade. And the way I would think of it is, if I lost 10 trades in a row, and trust me, it will happen to you. It's happened to me. You go through drawdowns. If you lose 10 trades in a row, is your account going to be okay? So with the $100,000 account, and I'm risking 1%, If I lose 10 trades in a row, my account will now be $90,000. Of course, I don't want it. I don't want to lose $10,000, but at least I still have a strong account. 90,000 is still pretty good. Same if you're trading a smaller account, you only have $5,000. You could lose 10 trades in a row and you'll still be at 4,500. So you haven't crushed your account through that horrible drawdown. Now, what a lot of beginning amateur traders do, or even longtime traders who just don't have a lot of good discipline, they trade well during the good periods in the market, but the second there's one of these ugly things that happens here or here, they get crushed because they are risking too much per trade, and pretty soon that $5,000 account is at 1 or 2,000. Now, you cannot have that happen, or that $100,000 account is now at 40,000. That's all too common, and once that happens, it's going to take you forever to get back to where you were. So protect your account. Think of your risk on a macro level. So the point, I'm not going to go through all of this lesson here. You can read it. You can go through the video. Make sure to do that. But the point here is think about all your trades together. So for example, if you are willing to take, say you have a $100,000 account, you're willing to take 10 trades. So most of your position sizes are going to be around $10,000. Now, let's say you're risking 1% per trade. You are now risking not $1,000. You are actually risking $10,000. So too many people just focus on that specific trade. Oh, I'm only risking 1,000. Yeah, but you took 10 trades. So you're risking $10,000. And if if the market crashes, think about what happens if the market crashes. Now, when we manage our risk, when the market crashes, you actually might lose more than you expect because there might be a gap down overnight. So now let's say you were risking 1%, but there's a gap down overnight, and now you've lost 2% for each trade. You've lost $2,000 for each trade. 10 trades, $2,000, you've just lost $20,000. So that $100,000 account is now $80,000. That's way too much risk for a specific period of time. You're going to get crushed if you trade like that because these events will happen to you. We can't predict always when these events are going to happen. You'll get, no matter how good of a trader you are going to get caught in one of these events. So manage your macro risk. If you want to be in 10 trades and you normally risk 1%, say, you know what, I'm not going to risk 1%. I'm only going to risk 0.5%. And now, instead of risking $10,000, you're only risking $5,000. Or you can say to yourself, you know what, maybe I shouldn't be in 10 trades. I'm only going to take 5 trades at 1%, and now I'm only risking $5,000 again. So manage your risk on a macro level, and your market analysis, which we just talked about, is going to come into play again. In very strong markets, I'm willing to risk a little more because I know the potential for gains is so big. So I'll say to myself, you know what? During this period, I'm willing to risk 7,000 at one time. Whereas, so in this period here, because I know I could potentially make 20 or 30,000 off that 7,000 risk. Whereas during this period, I know the potential for gain is not that much. So I'm only willing to risk in the macro maybe $3,000 or $4,000. So again, this is how the macro analysis comes into play when you're thinking about your risk. And as a swing trader, all of these pieces fit together. As a day trader, while you do have to pay attention to other things, but it's very stock specific. The trade I'm in right now, the risk for this trade. Whereas there are so many moving parts for a swing trader that you have to be thinking about to effectively swing trade. So that's the macro level. Now let's talk about, we're going to skip risk. We're going to get back to risk in a second. But let's talk about how I use moving averages. So, and I'm just going to run through this really quick. First of all, you see here the moving averages that I use are the 9 EMA, which is the exponential moving average, the 50-day moving average, and the 200-day moving averages. And there are a lot of other moving averages. Some people use the 20, some people use the 100, maybe some others. Don't clutter your charts. Have a reason for using these different moving averages. And the reason I use 3 is basically long-term, intermediate term, and short-term. This 9 EMA helps me identify the short-term trend. and short-term setups. The 50 helps me with the intermediate term trends and intermediate term trades. And then we have the long-term trend as well. So how are we using these? The first thing I do is we just talked about trends. I use these moving averages to help me identify trend. If the moving averages are going up, we are in an uptrend. Obviously, if they're down, we're in a downtrend, and if they're flattened, we're in a range-bound market. Now let's see how that played out with SPY here. So as you can see here, during this period here, well, first of all, when we were in this uptrend through 2017, basically all three were in steady uptrends. Every once in a while, the 9 would come back down for a short-term downtrend and then tick back up. So basically, we were always in uptrends. Now look what happened in 2018. Short-term, big dip down. The intermediate term flattened, and the long-term stayed in an uptrend. And that's exactly what's happening in the market. Long-term, still in an uptrend. Intermediate term, we went range-bound. And short-term, we were in a downtrend. So these moving averages are going to help you identify trend. Now, they're also going to help you with trend reversals. When you see that moving average flip up, you know you're getting a reversal in the market. We're starting to see that with the intermediate term now, where it was in a downtrend, it flattened out, and now is starting to push up, meaning we're back in intermediate uptrend. Short term changes a lot, but we saw very quickly it went back to uptrend. And then nothing really changed with the long-term trend. So that's one way to look at it. The other way moving averages help you is to identify overbought and oversold levels. Now, we're going to talk about that with stochastics, but my favorite way to identify an overbought or oversold level is how is that price action excuse me, related to the moving average. So for example, as we are in a trend, usually when we break out of a trend, that price action is going to be right around the 50. And as the trend extends, you're going to start to see a gap between the 50 and the price action. And when that gap starts to get really wide, starts to get out of its normal kind of standard deviation. So if we look at the 50 here, it pretty much stayed in a nice trend, whatever that gap would be. I could probably fit my index finger in there. But then look what happened here. All of a sudden, the market went nuts, and we started to see a huge gap in this. This could probably be 3 fingers in here. That was an indication that the market is really overheated and getting overbought, and we're ready for a reversal. In the trade report, we were talking about this. Like, a lot of people were going nuts. This market is fantastic. They kept adding positions. We actually lightened up here and did not get crushed by this pullback because we knew the market was extended. So it'll help the moving averages and price action in relation to the moving averages is going to give you an indication of overbought and oversold levels. So pay attention to that when you're trying to figure out if the market is overbought and oversold. And then we also have setups related to the moving averages. Basically, if I'm trading a continuation or pullback pattern, and the first thing we're going to do is see if price action tests that moving average to show strength. That's often a good entry. And also, if it actually dips below the moving average and then remounts that level, we call that a pullback remount setup. That's a very strong setup. So we use moving averages for that as well. So basically 3 ways I'm using moving averages. One is to identify trend, downtrend, uptrend, range bound. 2 is to identify overbought, oversold levels, and that's for the market or stocks. And 3 is for actual setups, usually pullback related setups. So, and also support and resistance levels. So those are the 3 ways I am using moving averages. So that basically recaps this lesson here. There's an exercise you can do in here, which will be really helpful, and obviously watch the video as well. All right, so let's go from moving averages to back to risk. We're going to talk about setting stops, taking profits, and risk ratio. And I'm not going to go through the lessons again. You can go in and read the lessons. What I'm going to do is I'm going to pull up Netflix, which is what we've been using, and just use that trade we recently took in Netflix to talk about setting stops, targets, and risk ratio. So let's start with the stops. Stops is when I'm thinking about a trade, I always start with the stop. Before I even think about where my target is, what the risk ratio is, we need to know where my stop level, where our stop level is. And that relates to what we talked about in terms of starting with defense instead of offense. Think of your profit taking and reward as offense. Think of your stop as defense. So when I entered here, when I was before I even entered, we're always coming up with a plan before we make the trade. So when I decided that this was a good setup, that doesn't mean I'm going to take it. I have to look at the risk and see if it's a trade worth taking. So first of all, I like the setup. I liked the market analysis was fantastic. What we talked about moving averages was good. I like the setup. We haven't gone over setups yet, but this is a continuation pattern. It was remounting the 9. So now you know what I'm talking about when I say a continuation pattern moving average remount. It had pulled back. It was a very strong stock, had moved from, in 2000, a year ago, it was at 200, and here we were at a high of 340. Very strong pullback that actually blew through a couple of the moving averages here, but then it remounted the 9. That's a classic continuation pattern pullback remount setup for me. So I knew I wanted to enter here around 314. Now I have to ask myself, where's the logical place I'm going to put my stop? And I decided I wanted to give it some room. I don't want to get stopped out of its natural volatility. So, I placed my stop around, I don't remember exactly now, but most likely it was 304 or 305. Let's just say 304 to make it easy. So I'm entering at 314. I'm placing my stop level at 304. So why are we placing it there? Again, you need to think about the natural volatility of the stock. And here I listed 3 different things. The maximum you are willing to lose, which is for us, if we're using that $100,000 account, we're willing to lose $1,000. Where does the stop make sense in the chart? And then does my position sizing make sense on a macro level? Will I make enough money on the trade? So according to where it makes sense on the chart, it would be right here around 304. That takes into account the stock's volatility and where there's support and resistance support levels. So we are willing to risk 10 points. Now, where is my target going to be? Now let's skip over to target. And I actually won't pull up the lesson. But generally for targets, you're going to think about a few things. What's the history of the stock? How does the stock usually move when it starts to move? And we know Netflix can make some big moves. Here, it moved from 348 to 325, almost 100% point move, 80-point move. Here, it moved from 273 to 335, so about over a 50-point move. So we know this thing can move. And then where are the resistance levels? And we knew there was a resistance level, which was the all-time high, right between 335 and 340. So previous price action told us we could hit this level. So initially we would say our initial, even though we did go for a higher based on our market analysis, remember we talked about the market analysis, initially we went higher, but we were talking about 335. So if I'm entering at 314 and let's say we go 334, that's 20 points and we're risking 10. So we're going to get 2 to 1 on our trade, which is exactly what we want. So let's skip over here to risk reward. Again, I assume you've read these lessons. If you haven't, go back and read them. But we're putting this stuff into practice now. But reward to risk, we generally want 2 to 1. So basically we're going to take here, I put the formula in here. Where you entered, subtracted by the target level, is going to give you how much you could potentially profit. Then where you entered from where your stop is going to give you how much you could lose. And then you're just going to divide that. So here it was 10 divided by 5 equals 2, meaning your risk is 2 to 1. So what are we doing here? We are risking 20 points. 334 minus 314 is 20. And that's not risk, that was our reward. We are risking 10 points, which would be 314 minus 304. So again, that's going to give us 2 to 1. So that we can take that trade. With some setups, I'm willing to go 1.5 to 1, but most setups are going to be 2 to 1 or higher. So in terms of reward to risk, this was a fantastic trade. In terms of where my reward and my target could be, fantastic trade. Now let's figure out how we have to position size for this. So we have a $100,000 account. We are willing to risk $1,000. And we know we're risking 10 points. So basically, if I'm risking 10 points, that means I can take 100 shares. So 100 shares times 10, which is what I would lose, would be 1,000. So essentially, assuming I have a big enough account, which we do, we have a $100,000 account, I could take 100 shares of Netflix at 314. It would cost me $31,400 to do that, and I'm only risking $1,000 of that $31,400. And that's, people tend to think if I'm taking a $31,000 position size, I'm risking $31,000. You're not risking $31,000. Your risk is only where you're going to get out. So we were risking 1,000 here to make 2,000, and actually, if you take the profit where I took it, you end up making about 4,000 on the trade, which ends up being 4 to 1, not 2 to 1. So it ends up being a fantastic trade. Okay, so that covers basically these 4 different lessons on risk: taking profits, risk ratio, setting stops, and on the macro level. So I think we've covered all of the lessons so far, or the challenges. Actually, I didn't go over the first one, but if you haven't already, go to the first one, because I listed some articles that I've written in the past. There's some really good ones here. 23 Laws of Part-Time Swing Trading, just some really good tips. General advice that kind of jumps around all over the place. Part-Time Swing Trading Made Easy. This is probably one of the best, I don't mean to sound immodest, but probably one of the best articles you're going to find on part-time trading if you have a job, because I laid out here basically my process when I had a now I trade full-time now, but when I had a full-time job, I was in the legal field. This is basically the entire routine that I use, and there's a video here that will kind of lay it out as well. So if you haven't already, definitely read this article. Probably one of the best things you'll find on part-time trading. Then there's some other links and articles here that are going to be really good. 21 Profitable Setups relates to what I was talking about, market analysis, where there are different setups and the type of markets you should be trading them. So for instance, if you're trading a trend pullback, you should be trading it in this kind of market. Divergence shorts, you should be trading it in this kind of market. So I listed 21 different types of setups in the markets you should be trading them. That's also a really good one. But go through and read all these. It'll give you a good primer on what we do. Okay. All right. So that covers basically the 8 challenges we've had so far. Hopefully you guys have gone through all of them and not only watch the videos, but actually are doing the exercises as well. Now, we did this for Netflix. Let's take a few of the other stocks you guys mentioned. And if you guys have any questions now, now start asking your questions in the chat. So I'm basically done with what I wanted to go over. Let's pull up Roku. And let's talk about, we've already done the market analysis, so I don't have to rehash that. The market analysis, we know, we talked about it. It's a strong market. We're willing to be aggressive right now. So Roku, meaning not only are we willing to take a lot of trades, but we're willing to be aggressive with our target. So I already have that. I'm in Roku right now, so this one works out well. I forgot, Rob, looks like you asked for this one, and Luke. But you can see where I entered. I have the arrow here. So let's talk about this. Let's hit the risk, all the different risk factors. So we've already done the market analysis. You guys know about moving averages. What else? You know about all the risk, overbought, oversold related to moving averages. So Essentially what we had here is an overall bottoming pattern in an IPO. We haven't talked about any of this, but just uh, assume we're trading a bottoming pattern within an IPO stock. And there's some different factors we think about when we're trading IPOs, but I don't really have time to go over all that right now. But just assume bottoming formation. It's also within the bottoming formation, it's a trend continuation because it started trending ever since it hit the bottom at 29. Now we have a trend pullback holding that key moving average, and that hammer here is where I entered. So you can see my entry here was in the 37s. I placed my stop right around 30. I use a tighter stop, about 1.5 points, but let's say we use 2 points to make it easy. Okay, so we entered at 37. We're gonna, actually we'll use 1.5 because 35 would be way too loose for this stock. So we're risking 1.5, okay? Now, where does it make sense? 1 second here. Yeah, Nick, the contest has ended, meaning you probably can't sign up right now, but we're still going to get to who the winner is right when I'm done with this in a few minutes here. Okay, back to Roku. So the entry was here at 37. Let's say we're placing our stop at 35.50, risking 1.5 points. Now, where is our target? To get 2 to 1, we really only need 3 points. So we're actually there already, but I'm still in the trade. So actually 40 would get us to our target. Now, where does it make sense within this stock to take profits? You could just go solely on risk reward, go to 3 to 1, 2 to 1. Okay, I made a really nice trade. I got 2 to 1, but we could actually go for a bigger win here. Points that make sense. The top of the range right here where the gap down was at 43. So that's another 2 points. Or all the way up here where the gap fills at 50, or the all-time high here at 57. All of these points make sense. And because of our market analysis, a couple of things I'm thinking about right now. One, our market analysis says the market is fantastic. Two, this area in terms of technology, Roku kind of fits technology. It fits media. Media stocks have been very strong. Pay TV, set-top boxes, all that kind of stuff. So when we factor all that in, we know it's in a good sector. We know the market is good. So I am willing, and on top of that, IPOs have been on fire. And Roku is an IPO late 2017. So all of these factors lead us to go for a bigger win. So I'm not happy with 2 to 1 here. Now I'll move my stop up. I'm not going to keep my stop way down here now, but we are going to go for a bigger win. So what I've told Trade Report members is initially I'm going to go for 44 to 45, and from there I'll reassess to see if I even want to go for a bigger win. So if that happens, this could be like the trade of the year if it hits all the way up to 50. So that's the thought process behind these trades. Just don't blindly say, oh, I've got 2 to 1, I'm going to get out. You have to, as a swing trader, you have to think about all of these forces that come together. Again, this kind of separates day trading from swing trading, where you really have to know a lot of things outside of your own stock when you're trading. So that's Roku. Let's talk about, you guys had mentioned HUYA. Again, market analysis says very strong market. Media, diversified. I think this is considered like the Chinese Netflix. So let's think about that. China has been on fire. I'm in Baidu right now because of that. Here's Baidu. So Baidu has been very strong. Chinese stocks in general have been very strong. Specifically, IPOs have been very strong, and Chinese IPOs have been very strong. So because of that, Huya is a fantastic stock. Now, I would not enter it here. It's very extended at this point. But let's say we were going to enter on this day on the break of the high. So let's say we were going to enter at 31. Now, we know the average daily range is very big on this stock. So we need to use a very loose stop. So if I'm entering at 31, my stop is going to be all the way down here, probably around 27, 28. Let's say 28. So I am risking 3 points. So I know I have to be able to get 6 points on this to make it worthwhile. So this thing needs to go from 31 to 37. Past history of the stock, moving from 20 to 30 very quickly told us it's doable, and it actually did do that in only 2 days. So risk reward was fantastic for this stock. So definitely a good stock to trade. Let's go over one more. Let's go over Lulu. Now, this is a stock I took profits in. We traded this in the trade report down here. It was a fantastic 10 or 12 point win. We couldn't hold through this breakout because this was earnings, and we always get out before earnings. But let's assume you're playing the earnings breakout pullback setup, and you saw that it was, it tested the 9, it held up, and let's say you were going to enter yesterday at 122. Now, where can we place our stops here? I like to play them at the bottom of the breakout bar, which would be about a 9 or 10 point stop. That's way too wide. We don't want to have to win 20 points on this. So essentially, if that's the only place I could place my stop, I would not take this trade. However, there's another good spot where the stock pivoted and under the 9 here. So now I can probably take the trade. Let's say we're going to place our stop at 119. I enter at 122. That's a 3 point stop. I only need 6 points for the target. Now I can take that trade. So that would make sense for Lulu. Okay. All right, guys. That's basically what I wanted to go over here. In terms of putting all this together, I hope you guys are seeing now how all of this fits in. And we're only at the beginning stages. We're on challenge number 8. By the time we get to challenge 20, 30, there's going to be a ton of stuff that fits together, all of these moving parts. You're going to learn these lessons piecemeal and then learn how to put this stuff together. That's what these webinars are for. So you see how we're putting all this together. By the time you get through this 30 days, you are going to be a pro at swing trading. So keep up, keep with the exercises. Ask me any questions. You can email me or save your questions for when we do the next one at the end of the month here. Now I'm going to do the drawing for the winner of a year of the trade report. Let me get into what the trade report is. If you go on Bulls on Wall Street, where you're reading these the free challenge here, and I'll also say this free challenge is probably a better kind of boot camp or teaching of swing trading than probably most trading services, and we're making it here for free. But swing trading alerts, this is that alert service I was talking about where I put out a daily report for every trading day. You get a report, you get a free video, not a free, you get a video with the report. You get a focus list where I list the 10 to 20 stocks that I'm watching every day. And then the video goes over what I'm looking to trade. During the day, there's trade alerts if I make a trade. Generally, depending on the market, there's some markets where maybe I only make one trade in a week. There's other markets where I may trade 5 or 6 in a week. So it really depends on the market. And then also something new we've added to the report, that's the 2 monthly mentoring sessions. They're usually on Tuesdays, twice a month. So next Tuesday is the next one. Specifically just for trade report members. It's not a public webinar like this one is, where I do a really advanced lesson for trade report members. And then we have a Q&A where I mentor the trade report members. Basically, it's like personal mentoring because you ask a question and I go into it in depth with you. So if you want to sign up, you can sign up here. It's $99 a month. It ends up being, I think, 50% off if you sign up for a year in advance. So a really good deal if you sign up for the yearly. Now, one person is going to get it for free. And let's take a look at who the winner is. And this was totally random here. We've got, I hope I'm pronouncing the name right, Drika Alves. So Drika Alves, if you're here, shoot me a message in the chat. We're going to contact you through email. We've got your email here. But you just won a year of the trade report, $1,200 value. You get the mentoring sessions, plus you get a half hour to an hour personal mentoring session with me. We'll schedule that. We can talk about, I'll have some stuff that I want to show you and teach you. And then anything you need to talk about will go into your account. You can show me how you've been trading. I'll break down the analysis and tell you some things, some specific leaks I see in your trading that you could improve on, which I'll be able to identify really quickly because I've seen so many traders. But you are the winner. That's Drika Alves, and we'll contact you after the webinar here. All right, guys, this was fantastic. Keep it up. Keep watching for these reports. Sign up on Bulls on Wall Street for the emails, and you'll get them emailed to you. Otherwise, go to the blog. I also post each one new on my Twitter feed. But definitely keep it up. It doesn't take long to learn. Spend a half hour to an hour every time one of these comes out. By the time it's over, you'll have spent 30 hours, and it won't even seem like that. And you'll really be a pro. I'm not joking. You'll be a pro at swing trading. All right, guys. So we're going to do the next one at the end of the month. So be sure to show up at the end of the month, and there will be a recording of this one as well, though, that you guys will have access to. All right, guys. This has been fantastic. I'll talk to you guys in a couple of weeks. And again, email me anytime you want, singjd1@aol.com.